The 2008 financial crisis was one of the most significant economic events in modern history. It had far-reaching consequences that affected millions of people around the world. But what really caused this crisis? And why did it have such a devastating impact? In this video, we will delve into the untold truth about the 2008 financial crisis. It all began with the bursting of the housing bubble. In the early 2000s, there was a surge in demand for housing, and prices soared to unprecedented levels. Lenders, eager to profit from this boom, started offering risky mortgages to individuals who could not afford them. These subprime mortgages, as they were called, had low initial interest rates that later skyrocketed, making it difficult or impossible for borrowers to repay. And yet, these risky mortgages were bundled together and sold as mortgage-backed securities to investors. This financial engineering allowed banks to offload the risk of default onto investors, who were often unaware of the true nature of these securities. As more and more of these toxic assets entered the market, confidence in the financial system began to erode. Meanwhile, financial institutions were heavily leveraging themselves, using borrowed money to make risky bets on these mortgage-backed securities. This practice, known as leverage, amplified potential profits but also magnified losses. As housing prices started to decline and borrowers defaulted on their mortgages, the value of these mortgage-backed securities plummeted. Banks and other financial institutions that held these assets experienced massive losses, which severely weakened their balance sheets. The crisis intensified when the interconnectedness of the global financial system became apparent. Many financial institutions had significant exposure to these toxic assets, and when one player faltered, it sent shockwaves throughout the entire system. The crisis hit its peak in September 2008 when Lehman Brothers, one of the largest investment banks, filed for bankruptcy. This event sent panic through the markets, causing a severe liquidity crunch and a freeze in lending between financial institutions. As lending dried up, businesses struggled to access capital, leading to layoffs and bankruptcies. The real economy suffered as consumer spending declined, and the unemployment rate soared. This combination of financial and economic turmoil created a vicious cycle that worsened the crisis. In response to the crisis, governments and central banks around the world implemented a range of measures to stabilize the financial system. They injected massive amounts of liquidity into the markets, bailed out troubled institutions, and implemented new regulations to prevent a similar crisis in the future. However, the effects of the 2008 financial crisis were long-lasting. Many individuals lost their homes and jobs, and the scars of the crisis are still felt today. It exposed fundamental flaws in the financial system and raised important questions about the role of regulation and oversight. The crisis also highlighted the dangers of excessive risk-taking and short-term thinking in the pursuit of profits. It served as a reminder that the health of the financial system is closely intertwined with the overall well-being of the economy. The 2008 financial crisis was a wake-up call for individuals, governments, and financial institutions alike. It revealed the fragility of the global financial system and the need for reform. It is essential that we learn from the mistakes of the past to build a more resilient and sustainable financial system for the future. As we continue to navigate the complex world of finance, understanding the untold truth about the 2008 financial crisis is crucial. It serves as a cautionary tale, reminding us of the dangers of unchecked greed and the importance of responsible financial practices. So, let us reflect on the events that unfolded in 2008 and consider the lessons learned. By doing so, we can work towards a more stable and equitable financial system that serves the needs of all individuals and contributes to the prosperity of our society. The aftermath of the 2008 financial crisis was characterized by a slow and fragile recovery. Governments implemented various stimulus measures to jumpstart economies, such as lowering interest rates and enacting fiscal policies to encourage spending and investment. Central banks stepped in to provide liquidity to financial institutions and stabilize the banking system. These measures aim to restore confidence and prevent a complete collapse of the global economy. However, the road to recovery was challenging and uneven. Many individuals and families struggled to rebuild their lives in the wake of the crisis. The job market was tight, wages stagnated, and inequality increased, exacerbating social and economic disparities. The financial crisis also exposed systemic flaws within the banking industry. With the collapse of Lehman Brothers and the bailout of numerous financial institutions, the public's trust in the banking system was severely damaged. This loss of trust spurred calls for greater transparency and accountability within the financial sector. Regulatory bodies and governments sought to implement stricter regulations to prevent a similar crisis from occurring again. In the years following the crisis, various regulations were implemented to increase oversight and reduce the risk of another catastrophic event. Measures such as the Dodd-Frank Wall Street Reform and Consumer Protection Act in the United States aim to strengthen financial regulations and protect consumers. In addition to regulatory changes, the crisis also prompted a broader examination of ethical practices within the financial industry. The pursuit of short-term profits at the expense of long-term stability became a focal point of public scrutiny. Critics argued that the crisis was largely driven by a culture of greed and excessive risk-taking within financial institutions. This raised important questions about the role of ethics and integrity in the financial world. The 2008 financial crisis also had a profound impact on the perception and understanding of risk. Prior to the crisis, many financial professionals and regulators underestimated the risks associated with complex financial instruments and relied heavily on credit rating agencies for guidance. The crisis exposed the limitations of these risk management strategies and highlighted the need for more robust and comprehensive risk assessment practices. As a result, risk management practices underwent significant revisions. Banks and financial institutions adopted stricter risk controls and implemented new methodologies to better assess and mitigate various types of risks. The 2008 financial crisis also ignited debates surrounding the role of central banks and their ability to manage financial instability. The actions taken by central banks during the crisis, such as injecting liquidity into the markets and implementing quantitative easing, raised concerns about their potential impact on inflation and long-term market stability. Critics argued that central banks' response to the crisis created a moral hazard, as it may incentivize excessive risk-taking by financial institutions in the future, knowing that they will be bailed out if things go wrong. However, proponents of central bank intervention believed that these measures were necessary to prevent a complete collapse of the financial system and mitigate the severity of the crisis. In the years following the crisis, the debate around central bank policies and their role in managing financial crises continued. The effectiveness of these policies and their potential unintended consequences remain topics of ongoing discussion and research. Another lasting impact of the 2008 financial crisis was the shift in public perception and attitudes toward borrowing and debt. Many individuals and businesses became more cautious about taking on excessive debt, recognizing the risks associated with over-leveraging and the importance of financial stability. This newfound awareness led to changes in consumer behavior and a greater emphasis on personal financial management. Individuals began to prioritize saving, reduce debt burdens, and adopt more conservative approaches to financial planning. Overall, the 2008 financial crisis has shaped the way we think about and approach finance on both an individual and global level. It exposed vulnerabilities within the financial system, prompted regulatory changes, and sparked important discussions about ethics, risk management, and the role of central banks. The crisis also led to a renewed focus on the importance of financial literacy and education. Many realize the need for individuals to have a better understanding of how the financial system operates and how to make informed financial decisions. Today, efforts to improve financial literacy continue, with initiatives aimed at empowering individuals to take control of their financial lives and ensure a more sustainable and resilient economic future. While the 2008 financial crisis had devastating consequences for countless individuals and communities, it also sparked a period of reflection and reform within the financial industry. Lessons learned from this crisis continue to shape the world of finance and inform efforts to prevent future crises. As we move forward, it is crucial to remain vigilant and proactive in addressing the vulnerabilities and risks that continue to exist within the global financial system. By learning from the past and working towards greater transparency, accountability, and ethical practices, we can strive for a more stable and inclusive economy that benefits all. The untold truth about the 2008 financial crisis serves as a reminder of the potential consequences of unchecked greed and irresponsible financial practices. It is through understanding and learning from these truths that we can build a stronger and more resilient future for our global economy. Thank you for watching. Please don't forget to like and subscribe for more videos.